Okay, so you want to own a five-star hotel. Picture it for a second. A grand lobby with marble floors, a doorman in white gloves, guests pulling up in black cars, celebrities checking into suites that cost more per night than most people pay in rent for a month. And somewhere behind all of that, money flowing in around the clock. That is the dream. That is what people imagine when they think about owning a luxury hotel. Here is what actually happens. Some five-star hotels bring in over $500 million a year in revenue, and some five-star hotels charging over $1,000 a night lose millions of dollars every single year. The same category of property, the same gold leaf ceilings, the same butlers, completely opposite financial outcomes. Today, we are going inside the real economics of one of the most glamorous and most misunderstood businesses in the world. Before we talk about money, you need to understand what you are actually buying into. Most people assume five-star means five-star decoration, fancy curtains, expensive sheets, a spa with candles. That is not how it works. The rating systems that determine this status evaluate hotels on hundreds of different standards, and here is the part that surprises almost everyone. Roughly 3/4 of that score has nothing to do with the building at all. It is about service, how fast the front desk moves, whether staff anticipate what a guest needs before they ask, how quickly room service arrives, and how it is presented. The physical building only accounts for 1/4 of the rating, which means luxury is not a state. It is an ongoing performance that never stops. At 2 in the morning, when 90% of the rooms sit empty and the lobby is silent, the standard does not go down. A five-star property runs between 1.5 and 3 employees for every single room, compared to a budget hotel getting by on roughly half an employee per room. And that difference in staffing ratio is the seed of an entirely different cost structure, one that explains why this business is so brutally hard to run profitably. Let's start at the very beginning, before a single guest ever walks through the door. According to widely cited industry development benchmarks, the median cost to build a luxury hotel in the United States runs over $1 million per room, and in major gateway cities like New York, London, or San Francisco, that number regularly crosses $2 million per room. So if you're building a 200-room luxury hotel in Manhattan, you're looking at a development cost somewhere between $200 and $400 million before you've checked in a single guest, and that cost breaks down in ways most people wouldn't expect. Land alone can absorb around 10% of the total budget, sometimes more in dense urban markets. Hard construction costs, the actual steel, concrete, and mechanical systems, eat up roughly 2/3 of the total. Furniture, fixtures, and equipment, the beds, the chandeliers, the kitchen and spa fittings, add another meaningful slice, and then design fees, pre-opening expenses, and a contingency reserve for the inevitable cost overruns round out the rest. Most developers aren't writing a check for that full amount out of pocket, they're borrowing most of it, and in a high interest rate environment, the cost of that borrowed money can run 6 to 8% a year, meaning a $200 million loan alone can carry $12 to $16 million in annual interest payments before you've hired a single housekeeper or turned on a single light. Here's something that sounds obvious until you actually run the numbers. The exact same hotel, same design, same room count, same service standards, can be worth completely different amounts depending entirely on where it sits. A five-star hotel in Midtown Manhattan can charge an average daily rate of $400 or higher, while the identical room experience in a secondary market might only command $250. That gap is not a minor detail, it's the difference between a business that works and one that doesn't. And there's a rule of thumb real estate professionals actually use in this industry. For every $1,000 spent on development cost per room, the hotel needs to earn roughly $1 in average daily rate at a stable 65% occupancy, just to break even structurally. Spend $1 million per room to build it, and you need to be charging $1,000 a night consistently, not just on weekends in peak season, but as a stabilized annual average, which means a hotel built at full modern luxury cost is often structurally challenged from the day it opens. This is exactly why almost every major luxury hotel development built in the last 20 years hasn't just been a hotel, It's been part of a mixed-use project, including luxury residential condominiums, sold off before the hotel even opens, with that cash used to pay down debt and make the hotel portion financially viable in the first place. Here's where most people's mental model completely falls apart. When you think of the great luxury hotel brands, you probably imagine those brands owning the buildings their hotels operate in. Most of the time, they do not. The major hospitality groups running the world's most recognizable luxury names are operators, not landlords. The actual buildings are typically owned by a completely different set of entities. Sovereign wealth funds buying trophy real estate as long-term wealth stores, real estate investment trusts, pooling investor money to own portfolios of hotels, private equity funds looking to buy, improve, and flip within 5 to 7 years, pension funds and insurance companies chasing stable long-term returns, and wealthy family offices preserving multi-generational wealth. These owners sign a hotel management agreement handing day-to-day operations over to the brand in exchange for fees, and this is where things get very specific. The brand takes a base management fee of 2 to 4% of all gross operating revenue, paid whether the hotel made money or lost money that year. Then there's a royalty or license fee for using the brand name itself, another 3 to 5% of gross rooms revenue. Then a marketing contribution funding the brand's global advertising and reservation systems, another 1 to 4%. Then loyalty program assessments, another 2 to 6% of revenue generated through loyalty bookings. Add it all up, and before a single employee has been paid, or a single bar of soap purchased, the brand is taking somewhere between 10 and 15% of total revenue in fees alone. Now let's talk about the single largest cost on the operating side: payroll. A 5-star hotel is not a building with a nice lobby. It's a live, around-the-clock service operation staffed by hundreds of specialized workers across housekeeping, front desk, concierge, security, engineering, culinary, spa, and revenue management. And, for a luxury property, payroll typically runs between 32 and 38% of total revenue, the single largest line item in the entire budget. Take housekeeping as a concrete example. A 200-room hotel running at 80% occupancy has 160 rooms to clean each day, and the brand standard for a proper 5-star cleaning runs about 45 minutes per room. An 8-hour shift gives one attendant 480 minutes, meaning you need 15 attendants working every single day just for room cleaning. But accounting for days off, sick leave, and vacation, you actually need closer to 21 full-time employees to maintain that daily coverage, before adding supervisors, a head housekeeper, and laundry staff. Replicate that model across every department in the building, and payroll becomes a massive, mostly fixed expense that does not shrink when occupancy dips, because a hotel room is not like a television sitting in a warehouse. If it doesn't sell tonight, that revenue is gone forever, which is the fundamental economic reality driving everything about how these properties are priced, minute to minute, through dynamic pricing systems, reacting to flights, events, weather, and competitor rates in real time. Here's something that surprises most people who think about this business purely through room bookings. Rooms carry the highest margin, somewhere around 80 to 85 cents of profit on every dollar earned. But the rooms department has a hard ceiling. There are only so many rooms, and every competitor is chasing the same guests. The revenue streams that truly separate profitable luxury hotels from marginal ones are the ones most guests barely think about. A single luxury wedding weekend, with venue rental, custom catering, bar packages, and room blocks, can generate several $100,000 from one contracted event. And because it's booked months in advance with guaranteed headcounts locked in 72 hours out, it comes with none of the uncertainty of nightly room occupancy. Corporate meetings are even more valuable, since companies funding travel budgets are far less price-sensitive than individual leisure travelers. And a well-positioned luxury hotel in a city with strong corporate demand can generate 20 to 30% of total revenue from conference business alone, arriving reliably midweek, exactly when leisure travel is weakest. Spa operations add another layer entirely, with margins around 40 cents on every dollar. And then there's the presidential suite, sometimes listed at $10, $20, even $50,000 a night, which is honestly not there to make money from room nights at all. It exists as a brand weapon, generating media coverage and prestige that no advertising budget could buy, quietly convincing a much larger pool of guests to book a standard room in the same building for a few $100s instead. There's a cost people almost never think about when romanticizing hotel ownership, and it's enormous: energy. A luxury property with a full spa, multiple restaurants, laundry, and around-the-clock climate control can consume well over 100,000 kilowatt-hours of electricity a month, with heating and hot water alone accounting for over a third of total energy consumption. And because pools still need to stay warm and the lobby still needs to be lit regardless of occupancy, a drop in guests does not produce a proportional drop in energy costs. This is a business with what financial professionals call high operating leverage, meaning costs are mostly fixed while revenue is not. So when revenue drops, profit doesn't just shrink proportionally, it collapses. During major global disruptions, luxury hotels across gateway cities have seen occupancy fall to single digits for extended stretches, while still owing full interest payments on hundreds of millions in borrowed money. And that is not a hypothetical risk. It is a structural feature baked into the business, because luxury travelers spend discretionary money and are always the first to cancel when conditions turn uncertain. Here's something that genuinely surprises most people. Some five-star hotels aren't primarily built to generate operating profit at all. Sovereign wealth funds and governments sometimes build luxury hotels purely to create international prestige and attract foreign investment into a region, treating the hotel as infrastructure rather than a standalone yield-generating asset. Developers sometimes build a luxury hotel into a larger mixed-use project, specifically to raise the value of everything else around it, since the presence of a globally recognized luxury name justifies premium prices for the residential and office space next door, with the hotel losing money on operations, while the developer more than compensates through higher sales prices elsewhere. Integrated casino resorts take this even further, where luxury hotels exist primarily as amenities to keep high-value gaming customers close, with the gaming floor generating the real money and the hotel functioning as a subsidized retention tool. If you ask most people how a hotel investor makes money, they'll say from room bookings, and that's only part of the picture. Experienced investors use techniques like cost segregation, reclassifying components that wear out every 5 to 7 years into faster depreciation schedules to unlock far larger tax deductions in the early years of ownership, and refinancing, replacing high-cost construction debt with lower-cost long-term mortgages once the property stabilizes, often pulling out tax-advantaged cash without selling anything at all. Over time, a well-located luxury hotel appreciates in value on its own, meaning an investor who held for 15 years while collecting depreciation benefits and refinancing proceeds can achieve returns that look nothing like the operating margins in any single year. Time to pull it all together and answer the actual question: how much money do you make if you do this right? Take a 200-room 5-star hotel in a major American city, built for around $200 million, with $140 million borrowed at 7% interest, nearly $10 million in annual debt service before anything else happens. In a strong year at 75% occupancy and a $450 average daily rate, total gross revenue lands around $32 million, and after payroll, energy, brand fees, insurance, and reserve contributions, operating income before debt service comes to roughly $10 million, leaving barely $100,000 in net cash on a $200 million investment once debt service is paid. Run the same hotel through a weak year. Occupancy drops to 55%, average rate softens, and because costs barely move, you land in an outright operating loss, while the loan still demands its full interest payment regardless. That gap between those two scenarios is what this business actually is. Not a cash machine, but a high-stakes, highly leveraged bet on consistent demand and pricing power. And the owners who survive long-term are rarely the ones best at running hotels day to day. They are the ones who structured their capital correctly from the start, diversified across properties, and used tax advantages and refinancing mechanics to generate the real return, the one that operating income alone could never have delivered on its own.